Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending July 28th, 2023. Looking at the market indexes for the week, the TSX was down a touch, while the S&P 500, Dow Jones, Nasdaq, and Russell 2000 were all up this week. Gold was up and oil was up to over $80 per barrel for the week. Looking at Canada, the International Monetary Fund is projecting a lackluster GDP growth for 2024 for Canada at 1.4%, and this has just been revised downwards by 0.1% from April's projection. The US is even worse with a 1% GDP growth for 2024, but still no recession. Slow manufacturing is causing a lot of the slow GDP growth. For Canada, the IMF is also looking for inflation not to come back to 2% until late 2024. Note that China's growth has accelerated in 2023 but will fall off in 2024, while India is doing well in 2023 and even better in 2024. Turning to the United States, the Federal Reserve raised interest rates by 0.25% on Wednesday. That was the big news for the week. The Federal Reserve announced Wednesday it had raised its key interest rate by 0.25% to 5.25% slash 5.5% range, the highest level in 22 years, as it continues to fight persistent inflation in the U.S. economy. The central bank statement hinted at the possibility of further rate hikes, but it did not suggest that more increases were imminent. Quote, the committee will continue to assess additional information and its implications for monetary policy, end quote, the statement said. During this post-monetary policy meeting press conference, Federal Reserve Chairman Jerome Powell remarked that the process of bringing inflation down to 2%, quote, has a long way to go, end quote. Powell stated that it is possible for the central bank to raise rates again at the September meeting if the data warrants it. The Fed chief also said that rate cuts are not expected to happen this year. On Friday, the PCE price index the US Fed looks at for inflation came in at 3% year over year, lower than expected. The month over month read was 0.2% as expected. On Thursday, the US GDP for Q2 came in at an annualized 2.4%, higher than the 1.8% expected, meaning the US is nowhere near a recession and their economy is relatively strong. That impressive Q2 pace was fueled in part by consumer spending, which, despite a pullback from recent growth rates, increased 1.6% during the period and accounted for 68% of the total economic activity. Quote, economic data followed a familiar storyline, all pointing to a buoyant economy that continues to cruise despite interest rates reaching their highest levels in more than 2 decades. For now, the indicators are still pointing towards a relatively soft economic landing, end quote, said Mike Lowengardt, head of model portfolio construction at Morgan Stanley. U.S. office buildings are struggling in the wake of a new reality. After the COVID-19 pandemic, the telecommuting culture has taken root, and as a result, downtowns are suffering. A late 2022 study heralding a real estate apocalypse in the making calculated that building values had fallen by an average of 44.8% by the end of that year. At the end of the third quarter of 2023, the U.S. office vacancy rate exceeded 20% for the first time since 2008, according to media reports. In San Francisco, Dallas, and Houston, the vacancy rate exceeded 25%. In Canada, the vacancy rate is lower but still rising. From an average of 16.9% at the end of 2022, it has risen to 17.7%. In urban centers, the average rate is 18.4%. This figure conceals a two-pronged situation. On the one hand, in Category A buildings, the average rate is 15.9%, while in Category B buildings, it is 22.7%. On the other hand, some cities have rates as high as those in the US, including 32% in Calgary, 25.7% in London, and 23.3% in the Waterloo region. Google parent Alphabet posted a stronger than expected quarterly result Tuesday afternoon, reflecting strength in its cloud business. The Google Cloud unit itself delivered a 28% jump in revenue year over year, while churning an operating profit versus a loss a year earlier. Shares of the tech giant popped more than 6% in extended trading. Microsoft came through with a stronger than expected profit and revenue for its fiscal fourth quarter, but shares of the tech giant sank in extended trading Tuesday as its revenue projection for the current quarter came in lighter than Wall Street's consensus. The tech giant reported tepid sales growth in Q4 and projected continued slowdown in its Azure cloud service business. The company also offered a forecast for its artificial intelligence services, saying it would enjoy a bigger impact on revenue in the second half of the fiscal year that just started. Ford Motors pushed back EV production targets and warned of widening losses on the vehicles, saying adoption has been slower than expected. Part of the problem is pricing, according to CFO John Lawler. Ford earlier this month lowered prices on its electric F-150 Lightning pickup, partially reversing several price increases in recent years. Quote, "The transition to EVs is happening. It just may take a little longer," end quote, Lawler said after the automaker's second quarter results, which beat Wall Street expectations, fueled by strong pricing and demand for Ford's traditional and commercial vehicles. Meta Platforms climbed over 4% Thursday after the social media platform operator posted better than expected Q2 results and provided upbeat Q3 revenue guidance. What really wowed investors was its guidance for the current quarter, which easily exceeded analysts' views. A good deal of the positivity comes from Facebook's digital advertising revenue rising again. Chinese companies and online retailers are driving this, according to Susan Li, Meta's chief financial officer. It's such a welcome development that investors aren't paying much attention anymore to big losses in the company's metaverse business. Meta's stock popped 8% in Wednesday's extended trading. The stock is already up 160% this year as of Wednesday's close. Now for some bits and pieces. It's starting to sink in that China's economic growth isn't going to be what it once was or what the nation's government wants it to be. Policymakers unveiled enhanced measures to help the country's property sector and increase consumption. The new moves came after Beijing announced Monday that China's GDP grew 6.3% year over year in the second quarter, well below the expected rate of 7.3%. Still, the Chinese government was otherwise short on details about what it would do next. Quote, "The absence of any major announcements or policy specifics does suggest a lack of urgency or that policymakers are struggling to come up with suitable measures to shore up growth," end quote. Julian Evans Pritchard, head of China economics at Capital Economics, wrote in a note. Quote, "Either way, it's not particularly reassuring for the near-term outlook," end quote. China's Politburo, the country's top decision-making body, held a meeting on Monday and pledged additional policy measures to bolster economic growth, which has been experiencing a slowdown in recent months. The Communist Party's top decision-making body indicated increased support for the struggling real estate sector and committed to boosting consumption and addressing local government debt issues. On the ground of this, property developer stocks surged in both in Hong Kong and mainland markets, with Longfor Properties and Country Garden Services climbing more than 25%. Hong Kong listed tech stocks also gained ground, with the Hang Seng Tech Index soaring about 6%. Chinese regulators have requested the largest technology companies in the country to submit case studies of their successful startup investments in consumer, telecom, and media sectors. This move indicates that the authorities are now willing to provide these companies with more flexibility in supporting such deals. Demand for Chinese equities is further supported by a report suggesting the possibility of reducing stamp duties as part of efforts to boost capital markets. Meanwhile, shares of tech giants listed on Hong Kong advanced on Friday. Consumer staples and automobile stocks also outperformed. Finally, turning to next week, we have companies reporting as Q2 reporting continues in the US and begins in Canada. So on Monday, we have Sony, Panasonic, SoFi Technologies. On Tuesday, we have Toyota, Merck, Pfizer, AMD, HSBC, Starbucks, BP, Uber, Baidu, the Canadian Dream Industrial REIT. On Wednesday, we have Qualcomm, Shopify, CVS Health, Suncor, Nutrien, Fortis, Intact Financial, Tourmaline Oil, Cameco, and IGM Financial. On Thursday, we have Apple, Amazon, ConocoPhillips, Stryker, Canadian Natural Resources, Cigna, Bell, Motorola, Pembina, Brookfield Infrastructure, SNC Lavalin, Parkland Fuel, Bombardier, TransAlta, and Lightspeed. And on Friday, we have Enbridge, TELUS, Magna, and Brookfield Renewables. We're a little bit light on economic events next week. On Tuesday, we have U.S. JOLTS job openings. Wednesday is U.S. crude oil inventories. Thursday is U.S. initial jobless claims. Friday is U.S. payrolls and hourly earnings for wage inflation reads. And we have the Canadian unemployment rate. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.